Hello, everyone, and welcome to MSUFCU's Financial Education Seminar Series. These presentations were created with you in mind, with the intention to give financial education on a number of relatable topics to help expand your knowledge of finances while connecting you with resources in our community. We have a number of diverse presentations planned for you this year, and you can explore and register for them by visiting us at msufcu.org/events. Today's event is being recorded. You can rewatch or share the presentation by going to our YouTube channel at youtube.com/MSUFCU and then select the seminar series from the playlist options. I'm Therese Bacon, financial educator with MSUFCU, and I'll be facilitating our webinar today. We really appreciate you all joining us to learn more about home buying basics with MSUFCU. We have two experienced mortgage lenders joining us. Allow me to introduce our hosts, Paige Lemon and Sisto Huelga. Welcome to both of you, and thanks so much for being here today. I'll turn it over to you to introduce yourselves to our audience, and then we can lead right into your presentation.
Thanks, Therese. Hello, my name is Paige Lemon. I am the mortgage department trainer here. I've been with MSUFCU for going on 13 years, which is hard to believe. This is my first official seminar series event, so I'm super excited to be a part of it.
Thank you, Paige. And my name is Sisto. I am a mortgage loan officer with the MSU Federal Credit Union. I am approaching 10 years working here at the credit union, currently stationed on the great west side of the state of Michigan. And yeah, we are very glad that you joined us to learn a little bit more about purchasing a home, what to expect, and we couldn't be happier you're here.
Excellent. So we will talk about quite a few different topics today. Sisto and I are just going to kind of take turns running through these. And like Therese said, it'll be recorded, so you can always play it back or pause if you need to get more information. I'll let Sisto kind of take it away.
Perfect. Well, thank you so very much, Paige. Since you are here, I am going to assume that you are looking to purchase a home, which can be a very daunting task as well as a very rewarding one. But it's really hard to know where to begin most of the time. So as lenders here at the MSU Federal Credit Union, what we would recommend would be talking to a mortgage loan expert, which we offer all over the state of Michigan and now Illinois, to speak to us about what is possible. You have many different ways where you can try and start a mortgage application. You can apply over the phone. You can apply through the mobile app or computer line online account, or you can do it at person at a multitude of different branches across the state. When you're looking to get a pre-approval, you will need to provide income documentation, different asset documentation about your bank accounts, potentially retirement statements, different funds you're looking to use for the purchase of your home. MSU will need to access a copy of your credit report, as well as request different information about other properties you may own, the insurance and mortgage information if there is one listed on there. With all of these pieces of information, we can look to see what potential purchase price you could look at, potentially buying that does not cause any financial burden to your current situation. So when you are looking to move that next step and get a purchase in place, what do you do? What do you expect? So once you get a pre-approval, which is that initial kind of good faith backing from a financial institution, you then look to work with a realtor and then put in offers for a potential to buy a home. So what happens when that offer gets accepted? Well, when an offer is accepted to the terms you've presented, you are then presented with what's called a finalized purchase agreement or a fully executed purchase agreement. That is a contract now in place that sets terms of your purchasing the property that's listed on it. So the standard practice is once you have that finalized purchase agreement, you would then provide that to your mortgage loan officer, who would then provide you with a good faith estimate of terms to expect moving forward. It'll have an itemized breakdown of costs with estimates, since we don't know all of the information yet, and we still got a lot of due diligence to do. They may request additional documents at that time to make sure that we have everything required. And then if you choose to, and we strongly recommend, you would conduct inspections on that new property that day. That is to make sure that the property is in the condition that the credit union will accept as a quality of home, as well as to make sure it's something that you're comfortable with. We do not necessarily worry if it's ugly or needs to be painted or it needs to have any additional coloring that needs to be done. We are just making sure that it's habitable year round and has all the aspects of a home that would be needed to call it a place where you can lay your head down. So once the inspections come back, if it comes back in a condition that you're comfortable with and there's no real concerns, well, then we can look forward to ordering the title work or verifying the history of the property and its ownership and ordering an appraisal to make sure that the value is there to support your purchase request. Now, let's say, though, the inspections come back and then they are showing some not so nice things. Maybe there are some issues underneath the property, the foundation is crumbling, and it just looks like there's going to be some work that needs to be done for you to get comfortable. You can always go back to your agent and see if you can look to renegotiate, maybe get some of those repairs taken care of, maybe get a lower price. This is really when you're going to lean on your partner as the realtor themselves to make sure that they are advocating for you and entering in those negotiations with your best benefit. Now, if they're unable to move forward, that's okay. Sometimes you walk away from a property because you're just not comfortable. We can then reactivate your pre-approval and you can continue your search. So that is not just the end of your process. We can always restart and then continue looking without having to restart from the very, very beginning. But let's say that the property came back beautifully and you ordered the appraisal and the value comes back in line with what you're expecting. That is great news. We then will send it to what's called our underwriters, which double and triple check kind of all of the work we've done to this point that makes sure that everything fits in there, the box of legal and within the guidelines. And as long as everything looks great, we look to schedule what we call a closing day where you go in and sign and purchase your first home. So I have mentioned through all of that a lot of different names and a lot of different people with professions. These are really your mortgage teammates. You are going to be hiring a lot of third-party individuals who will be acting on your behalf and making sure that you're making a good decision that you're comfortable with. How I would say myself as the lender, I am making sure that you and everything you are looking to do fits within this little box called not financially burdensome, and that you could look to support it with your current income and assets that you have. The realtor is going to be really in charge of the transaction and making sure that the negotiations, the communications with the other listing agent is smooth, and making sure that all the documentation that you put together associated with the transaction is right and legal as well. We're going to have the inspector who's going to go through the property if you choose to hire an inspector and make sure that it is in a good condition. They will go through with a general report focusing on different items: plumbing, electrical, HVAC, also known as the ductwork or heating, and make sure that everything is in a certain condition. They're going to let you know the age, how it's running, and it's going to be a really good piece of advice to know what you're getting into when you're looking to purchase a home. And then you have the appraiser, who is, again, a neutral third party who you are going to hire through us to provide a value on that home. They will give you a full report, compare it with other properties of similar make and build in the area, to make sure that, again, the value you're looking for matches what the current market has. And then the title company, which most people don't know about, which I commonly refer to as them verifying if whoever owns the property legally can even do and has the right to sell it to you. They go through the history, make sure that there's no hidden ownership or anything that could jeopardize your ownership going forward. So with that, I will pass it along to Paige to talk about the different property types that you could look to expect to buy.
Perfect. Thanks, Sisto. So we do offer a range of property types for our membership that is looking to buy. First, and I think most common one is going to be the owner-occupied primary residence, which just means that it's your homestead. That's the home that you're primarily living in. And we offer a lot of different types of properties: single family homes, site build, manufactured, condos, up to 4 units. So that would include like a duplex, a triplex, or up to 4 units. To be owner occupied, the person that is purchasing must occupy one of those units. And we offer as low as 0% down on some of our specialty products or 3% on our conventional products, which I will get into in a little bit. We also offer mortgages on vacation homes. So that's going to be a little further from your primary residence, also known as a second home, would need to be suitable for year-round occupancy. So not like a cabin style, but would need to have running water and would need to be livable all year round. We do require a little bit more of a down payment for those types of properties. 10% down is required. And then we also have a non-owner occupied or investment, also sometimes referred to as a rental property. So those also have some different stipulations, maximum 15-year term with 20% down payment required. And it does need to be financed by an individual, not a business. Finally, we have our vacant land loans. So that can be a lot that's purchased for the construction of a new build, or it can be recreational land for other purchases. Most of these we offer in 20 states. So we have these states on the bottom of the screen here. But we have several different products to fit the needs of our diverse membership. I'm going to highlight a few of those over the next few slides. The states, like I said, are listed down below. Several in the Midwest along the East Coast and Southeast, and then there's a few other states scattered throughout the US. Our standard conventional loan, which is this first slide here, it features competitive rates that are compared against the market multiple times per week. We also have low fees to ensure that our founder's mission is kept alive. Down payments as low as 3% of the purchase price, and terms ranging from 10 to 30 years to kind of fit with each individual borrower's needs. And then for home buyers who have not owned real estate in the last 3 years, we have additional first-time home buyer benefits, such as a $500 credit at closing, an MSUFCU gift, and free education opportunities. I know that when I purchased my first home, I qualified for a tax-free withdrawal from my 401k, and that was to help fund my down payment and closing costs. So before you purchase, it's always a good idea to check with your tax or investment advisor to see what options you might have available to you before you apply. Then for a pro tip that I've added in here, the Understanding Private Mortgage Insurance, or PMI, that is going to help you along the way. So with a lower down payment, in the event that you're putting less than 20% down, you may run into additional insurance requirements such as PMI. When you're bringing less than 20% down, you can pay that PMI premium each month along with your monthly payment, or you can pay it upfront in a lump sum. So sometimes that can even be included with seller concessions. So the seller could actually pay that lump sum PMI payment on your behalf. That could be an additional benefit for you. So again, looking into some of those options and becoming the expert is always going to help you, and we're here to help as well. Next, our Heroes Loan product. So this one was designed for select employee groups, and it does not actually have a down payment requirement. So you can put 0% down. There is still a closing expense, but it's much lower than some of our other loan products because you don't have that down payment. So the closing costs could be a couple thousand to a few $1,000s, and it makes homeownership much more attainable. Keep in mind that gift funds or other savings can be used to pay those closing costs as well. Some of the employment groups that qualify for this product would include emergency responders and associates, law enforcement, government employees, healthcare, daycare, elder care providers, active duty military, teachers, retail, restaurant and credit union employees, construction trades, and many more. That list is constantly expanding, so I would encourage you to submit an application today to see if you might qualify for that. For this loan product, since usually there's going to be less than 20% down, you would have to have that PMI coverage. So PMI is required on this product, and we would require proof of additional savings. So as you can see that financial reserves, we want to make sure that you have some funds in a savings account for backup to back this loan. This is going to be an excellent option for the first-time home buyers or folks that haven't had a long period to save for a big down payment. Next one that we'll highlight, and the last one that we'll highlight, but certainly not our last offering here at the credit union, is the construction to permanent loan. So that's going to be designed for borrowers who are looking to build their home rather than purchase one from a previous owner. It's important to note that these are only available in Michigan and Illinois, so they don't follow the 20 states that I mentioned in our previous slide. But for these loans, we offer as low as 10% down, and we'll work together with you and your designated builder to ensure a smooth application, planning, and closing, followed by the construction process with regular inspections and finally moving into your new home. Your rate is locked in during the application process. So that ensures fixed loan terms at closing and throughout the construction phase. And then during that 12-month construction period, you're only making interest payments. So that makes sure that you can afford your current livable housing expense without having to pay for a second home that isn't livable just yet. And then after completion of the build or 12 months, whichever comes first, your loan converts according to the amortization schedule, resulting in that full monthly payment. You don't have a need for a second closing, so all of that is already planned ahead of time and it just converts automatically. And then the other cool thing is that in the event that you're under budget at the end of your build, we can calculate your payment over again at no cost to you. So we kind of recalculate based on that final loan amount if it ended up being less than what we had originally calculated. Also, because we offer vacant land loans, you're welcome to finance that with us as well. So you can do that land purchase and build on that property. And we offer some benefits if you have both of those loans with us. Sisto, I think you are muted.
Thank you so very much for that, Paige.
You're welcome.
So now that Paige has talked about the different type of loan options that we have, when you come to speak with a mortgage loan officer, what are they going to be looking at? What kind of things should you know to be prepared for that meeting? And a couple of things that we would talk about is your income and employment, as well as the assets and the savings or funds that you have available to make that next purchase. So with income, there is a standard set of requirements. For example, income must be verifiable, have a 2-year history, be taxable, and in some cases, like child support and alimony, have a 3-year continuance, meaning that it is expected that that level of income will be continuing with no change to the downside for the next 3 years. Even if you've recently changed employers, worked in the same field, or went to schooling, those still count towards that 2-year history. A lot of people, especially when they're graduating from college, feel like they don't have that work history available. We just need to look at that history of the past 2 years, seeing if there is a gap in employment. If you are leaving college or higher education, that can be considered towards that history. So I would not be too concerned about that. We would just request the transcripts from your higher education institution to verify that history. Same thing with military leave. That can also count towards that 2-year history. So don't be worried if that interrupts a continuous 2 years of employment. The best way to determine what we can use and how we can use the income would be to apply with a mortgage officer to see. Now, when we look at the assets or the savings, there's a lot of different funds we could look at. We could look at savings accounts, checking account, maybe you have some certificates, stocks and bonds, even retirement savings such as a 401k. All of those can be considered assets used for the purchase of a home. And if you're looking at a primary residence and not an investment property, that does also offer the options for a potential gift from a qualified donor, most commonly those with blood relations or people that you are in a relationship with. So what are these assets? Well, they are funds that on deposit that can be sourced. And what we mean by sourced is we need to know where they came from. With that, we just need statement history, knowing that they came from a place in your name. So unfortunately, if you have cash in your home in a safe somewhere, that is considered not verifiable and not sourced funds. I would encourage you to get those to a bank account or any type of an account with your name on it, so that they can sit there for roughly 60 days. That is called a seasoning period. And once they've been in there for 60 days, then with that point, we don't need to have that additional verification point. So what are these assets used for? Well, there are three common buckets that I refer to when looking to purchase a home. You have your down payment, which is the one that most people commonly know. That's your amount of money that you're bringing to the table, and you're using that to reduce the amount of mortgage or loan that you borrow. And so you'll have the purchase price minus your down payment funds, which results in the remaining mortgage amount that you're borrowing. The second bucket is referred to as closing costs, or I mentioned is you paying third parties to make sure you're making a good decision. So that would include the lender or loan origination fee, which pays for my team's time and labor to get you from start to finish, an appraisal to make sure it has the condition, or sorry, it has the value of the property you're looking for, the inspection to make sure it's in the condition you want, title to make sure who's selling it to you legally can do so, and then other ancillary fees if they apply. Credit reporting fees, flood determination fees, verification of employment if your employer charges. And that is kind of a second bucket that I would say when you're looking at around a $200,000 to $250,000 general purchase, we estimate those costs currently to be around $3,500. And those would be on top of your down payment. Now, if you are a first-time home buyer and you choose to purchase your first home with a credit union, we do help with those closing costs out a little bit. We do offer a $500 discount and a lot of education to all the first-time home buyers that apply with us. And then we also have ongoing promotions throughout the year as well. So please, I encourage you to check back into our website over the course of the year to see what offerings we have. And then the last bit of funds that would be needed is always the hardest to estimate, and the one that most people know least about is commonly referred to as prepaid expenses and escrow funding. So when you purchase a home has some required expenses no matter what going forward. You're going to have property taxes, you're going to have insurance, and those are due usually in lump sums a couple times a year. So what an escrow account does is it allows us to take these large annual full year expenses, divide them by 12, and add them onto your monthly payment. So you have those budgeted and you are not hit with those large lump sums when they are due. But in order to set up that account, we may need a little bit ahead of time to pad that escrow account because we may not have a full 12 months before those different expenses are due. So that gets a little bit harder because that's very property specific. It's going to be specific to what part of the month you're closing and the quote you get on some insurance. All of that will be estimated in the initial pre-approval, but as things come down and we get more refined information, we'll look to get more accurate and accurate. And then lastly is the financial reserves that Paige mentioned earlier. They are sometimes requested to verify that you have additional funds outside of what is needed to pay for and purchase the home specifically, more or less just to make sure we're not liquidating every last penny you have to buy a house. From own personal experience, I can say that you never know. Even if you do get an inspection, things can happen within the first month that you no longer have a landlord to turn to. That is your responsibility to take care of. So that it's always nice to have a little bit extra padded just in case. Now, I mentioned these assets. Let's bring them into a little bit of a full scenario here. So do I have enough assets to purchase this home? And this is a very common question that I have, or do I have enough money available to purchase this home? So this is a really good example for what I would consider a place to shoot for. So with an example purchase price of $200,000 using a 3% down payment, that would mean your loan amount or mortgage amount would be $194,000. $4,000. With the estimated closing costs of around $3,500, as mentioned earlier, and we have an estimated homeowners insurance premium of $1,200. Preparing that escrow account may estimate to be around $3,800, giving us a total estimated funds to close, or amount that I would have my members shoot for, of around $14,500. That should look to encompass all of the costs of those three buckets. And then I prefer to try to do initial worst case scenarios so that we can shave a little bit off and give you some money for a couch, because we know we now got a lot of space to fill. That's always the best. And then we shoot for 2 months reserves. That's not always required, but it's always nice to have that little padding just in case.
Perfect. Thanks, Sisto. So another big factor while we're talking about mortgages and qualifying, we want to breach this credit score topic. So an excellent credit score is going to be above 740, usually qualifies you for the lowest interest rates with most lenders. Keep in mind that your credit score is not the only factor that determines your interest rate, but it does hold some weight. To find your unique credit score, you can visit www.annualcreditreport.com, or you could contact each of the three or any of the three credit bureaus directly, which are listed there on the slide: TransUnion, Equifax, or Experian. Or you can also opt into My Credit Score on the MSUFCU mobile app or computer line, which we will provide quarterly updates of your score. Credit scoring models will vary by institution. So if you receive a 740 at, let's say, an auto dealership, that doesn't always equate to a 740 at a credit union or a bank. So there is some variance in that. When you apply for a mortgage with us, we acquire a credit report from all three credit bureaus, and an inquiry is logged with each one. Something important that I want to bring up here is the idea of credit trigger purchasing, which I'll talk a little bit about. We do receive a lot of feedback on this, so I figured it was a good time to bring it up. Many lenders out there, they purchase credit trigger leads with the credit bureaus, which helps them to receive alerts each time a credit inquiry is logged. So each time you apply for credit, an inquiry is logged, and then those lenders will receive a notification that you have applied for a certain type of credit. That credit trigger leads to confusion and frustration sometimes with consumers, because they'll begin to receive unsolicited phone calls or emails with pre-screened offers, including credit cards, insurance, and mortgage loans. So rest assured that MSUFCU does not purchase those credit trigger leads, but we don't have an option to prevent our membership from being included in those purchases elsewhere, the information that may be provided to other lenders. So wanted to point out on your screen here, you have three options to help yourself opt out of that process. So you can sign up for the National Do Not Call Registry. You can opt out of the pre-screens online. So that website is listed there for you, or over the phone. And then you can also contact your elected officials to speak out about the current credit trigger laws. So when we're looking at which scores to aim for, you want to be, 740 or higher is going to be the best. I want to share how you can reasonably build that healthy credit score. So your score is determined by several different factors listed here on your screen. The most impactful is going to be your payment history. So in order to make sure that you pay everything on time, you could set up some auto payments or make a bill tracking spreadsheet to ensure that every single payment is made on time each month. Next largest factor here is the amount owed compared to what's available on your revolving lines of credit. So to build your best credit score, you want to pay your credit cards in full each month, only spend what you can afford, and then pay that full credit card balance each month. If you do need to make a larger purchase, because we recognize that sometimes credit cards are used to make purchases that you wouldn't normally be able to afford in cash, you still can do that, and you still can build a healthy credit score with using credit cards, but it would be best to ensure you have at least 70% of the credit limit available to use. So on a $10,000 credit limit, your balance should not exceed $3,000, and that will help you to build that healthiest credit score. The other factors here include length and type of credit. A healthy credit score is going to have multiple trade lines open and varies in type. So, for example, one auto loan, two credit cards, a mortgage, a personal loan, maybe some student loans, and that would kind of give that full type of credit variance that they're looking for when they're determining that score. And then each time that you apply for a loan or a credit card, an inquiry is logged. So we talked a little bit about those inquiries, and excessive inquiries or multiple recent trade lines opened within 3 to 6 months can be viewed negatively. So that's just something to think about. You can always monitor your credit score, like I said on the examples that we gave above or on the last slide, just to make sure that you are keeping a close eye on it. If there are any errors, you can dispute those through the credit bureaus. If you notice something that didn't belong to you or that was recorded incorrectly, you can dispute those through the credit bureaus as well. So keeping a close eye on those will help you avoid any fraudulent situations or mistakes, and also just hold yourself accountable to building that healthy score. Finally, a little bonus slide because I know this was about home buying, but the step after home buying is looking for post-closing refinance opportunities. So after you've purchased your home, it's not one and done. It's still important to regularly evaluate the status of your loan for potential savings for yourself or opportunities. So as the market fluctuates, the rates will rise and fall, and slight rate changes on a loan amount as large as a mortgage, maybe 0.5% to 1%, could greatly impact your monthly payment or that amount of overall interest paid. Lump sum payments are another way. So, watching those rate decreases, but also if you're making lump sum payments, like maybe you got a large bonus at the end of the year and you applied that to your mortgage and the loan amount had a significant decrease, we could re-amortize that payment for you for free. Or if, let's say, each month for the last couple of years, you've applied just an extra $100 to $200 on top of your original mortgage payment, that also decreases that principal by more than what was originally amortized when we started this loan. So, all of those things we can look at recalculating and reducing that monthly payment and the total amount of interest paid. Finally, another opportunity for a potential refinance may be with the intention of taking cash out for another purchase, for home improvements, or paying off existing debt. So, although that option doesn't lower your mortgage obligation, it could lower your financial burden by rolling all of those payments into just one payment. Or if you're paying a high rate, let's say on a credit card, and you roll that into your mortgage, you would end up saving money on interest. So, we do have all of those options just to look at as well after you've made that initial purchase. So, keep your eyes peeled there. Thank you so much for letting us kind of present to you here today. We have the pre-approval information displayed on your screen for you. Keep your eyes peeled for more mortgage videos so we can help make home buying easier. Thanks.
Thank you guys so much for being with us today. And yes, everyone, go ahead and check us out at msufcu.org, or you can reach our mortgage department at 517-333-2424, extension 2105. All right, thank you both for being here, and we hope to see you back at another seminar series event soon.
Thanks, Therese.
All right,
Thank you.
bye-bye.